Hi, it's Mark again. This is the third video in this series. I would like to speak today about valuations or appraisals. An appraisal or evaluation is where a certified licensed appraiser goes out to a property to determine what the property is worth. Now, there are many kinds of appraisals. There's BPOs, which are broker price opinions, where a broker will evaluate. Those are simpler and cheaper. Then there are actual appraisals for residential properties, 1 to 4 units. And then there's the more advanced commercial appraisals, which is for a 5+ unit or a mixed-use commercial property. Today, we're going to focus on appraisals for a 1 to 4, a regular residential appraisal, because that is the overwhelming majority of what we do. Now, the way it works with appraisals is that there is a licensed appraiser who will go out and evaluate. Now, the appraiser needs to remain completely impartial, and so he cannot have a direct relationship with us, with us or with the borrower, because then that may affect his decision making. So the appraisals are done in what we call the arm's length transaction or relationship. There are companies called appraisal management companies, abbreviated AMC, and they are like a broker. They have appraisers who are registered with them all over the country. We order the appraisal from the AMC. Then the AMC goes and has one of their appraisers go ahead and do the appraising. Now, the typical appraisal management companies that we use, you'll hear, are Appraisal Nation, Clear Capital, there's a company Accurate, but the overwhelming bulk of what we do use is typically Appraisal Nation. Now, the way it works with Appraisal Nation is we order the appraisal, they send a payment link to the borrower. The borrower is the one who pays for it. We don't pay for the appraisal, the borrower pays for the appraisal. The payment link goes to the borrower, he pays, and then the appraiser will reach out directly to the borrower to schedule a time to come out and evaluate the property. Now, the way the evaluation works is that typically they are interior appraisals where the appraiser will go in, take photos. He typically needs access to the entire property. He will take photos determining the condition of the property, and then he will look for comps in the area or comparables of what's sold in the past 60, 90 days, typically within 3 miles. If he has to go further because there are no comps, he'll go further, but then typically he'll have a letter of explanation in the appraisal explaining why he went further or further back in time. Now, imagine if property A, which is a 4-bedroom house in the vicinity that is similar condition, sold for $400,000, and property B, which is a 2-bedroom house in the vicinity, sold for $200,000, then this property that is being the subject, which is a 3-bedroom house with the similar condition, is worth, say, $300,000. Each property typically tries finding as close square footage, as close condition, as close in features to the actual subject, and then will write why this one he believes is slightly more. Well, this one has an additional half a bathroom. That one is less because it appears to be in a worse condition, and eventually come out with a value of what the as-is value is. Now, if the sale price of the property on the contract is $100,000 and the appraiser says the property is worth $110,000, great, awesome. We may even go above the typical amount of money we will lend on the sale because the property is worth more. If the appraiser comes back and says that the property that is under contract for $100,000 is actually only worth $90,000, we are going to base our lending off of the appraisal. Now, the appraiser will need, if it's a purchase, he will need the contract because he does have to see what the person is paying. That does help determine what the value is. Typically, one of the best ways of evaluating a property is what somebody will sell a property for and what somebody will pay for a property. So they will be looking for the contract. Now, if the real estate deal that we are funding is a fix and flip where there's going to be rehab done, and we will be funding the rehab, then the appraisal will be an as-is and after repair value appraisal. The appraiser will have to get the scope of work that you're going to provide to us, besides for the contract if it's a purchase. He will then review the scope of work in the property and then find comps for the as-is condition, find comps for the after repair value condition, and then have a as-is and the ARV valuation in the appraisal, and that will allow us to determine whether the amount of money you are looking to invest, which we will hopefully fund for the borrower, is actually worthwhile doing. Typically, we will go up to 80% of the as-is value and no more than 75% of the after repair value. The reason why it's slightly lower is because there is an inherent risk in doing rehab that it will take longer, it'll cost more, things will go wrong. So in order to give us some more protection, we make sure that the loan doesn't top typically 75% of the after repair value. Now, another thing to discuss when it comes to appraisals is disputes. The appraiser says the property is worth $100,000 and the borrower is paying $150,000 and says, impossible, it's worth way more money. Then you are able to file a dispute. We do not have any control over the appraiser. We don't know him. We don't speak directly to him. The only thing we could do is deal with the AMC, which will typically be Appraisal Nation, and try to send a dispute. There's a specific dispute form where you will find 3 comps, whether they're as is or after repair value, and show that why did the appraiser not look at these comps when they are closer to the subject property, they're closer by, they're more like, whatever it may not be that your argument is. We do not control it. And I must warn that it's very likely for borrowers to inflate the value of a property in their mind. People like to think that they're getting a better deal. Sometimes they are right. Sometimes the appraiser doesn't know something that the borrower does know. But typically the appraiser lives in the neighborhood. This is what they do for a living. And if they're giving a certain evaluation, almost always there's good reasons behind it. I've rarely seen a challenge that has gone the way of the borrower. The appraiser is a licensed professional, and when you are disputing them, their credibility is on the line, and they will do everything they can to show that they were correct. And most of the time, to be honest, they are correct. The borrower has a personal interest in seeing the property being worth more, and so they will overlook things, whether it's the quality of the property, the condition, the neighborhood, etc. I will say probably 95 of appraisals do come back within 5 to 10% of what the borrower thinks it is worth as is and after repair value, 95% of the time. And if it does come back somewhat lower, then we lower the loan to value. The loan amount doesn't mean we can't lend. This concludes the video on appraisal and valuations. If you have any questions, please don't hesitate to comment on the video and I will respond. Thank you.